Coming up on Market to Market. Remnants of winter complicate life in the Ohio Valley, while arid conditions fuel wildfires further south. And producers navigate a complex maze of new federal support programs authorized in the Farm Bill. Those stories and market analysis with Ted Seifried next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, March 20 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. The Federal Reserve has held interest rates near historic lows for more than 7 years. And this week, America's central bank indicated it's in no hurry to revise its monetary policy. The Fed signaled Wednesday that it likely will not raise its benchmark interest rate before June, and perhaps not until 2016. The Dow Jones Industrial surged more than 300 points on the news, but one day later, the Dow gave back about half the gain as another plunge in crude oil prices weighed heavily on the market. The U.S. dollar also reacted to the Fed decision, posting its largest single-day decline against the euro in 5 years. The major currency of global commerce recovered about half the loss in the ensuing session, only to tumble again on Friday, reversing previously declines on Wall Street and in crude oil. Even the weather was volatile this week. And as the calendar advanced to spring, some parts of America endured a miserable hangover from winter.
Warmer temperatures returned to the Midwest this week, but in Ohio, heavy rains and rapid melting of snow led to severe flooding. The Ohio River rose to its highest level in nearly 2 decades. Roads, businesses, and homes were swamped in the Cincinnati region. The last time the Ohio was this high was back in 1997. 2 weeks ago, the south side of the Ohio Valley was gripped in drought. A look at the drought monitor from the University of Nebraska reveals the return of arid conditions in the upper Midwest and increasingly dry conditions in the west and southern plains. Currently, nearly 54% of the contiguous U.S. remain in some form of drought, third highest level in the last year. Further south, parts of the tinder dry Sooner State burned this week. This wildfire near the Panhandle scorched more than 37 square miles. The Oklahoma State Patrol said at one point the fire was more than 6 miles long, prompting authorities to issue evacuation orders. And with California locked in its 4th consecutive year of severe drought, policymakers are taking drastic measures to help those in need of water. Governor Jerry Brown and Democratic leaders proposed $1 billion in drought relief spending in the Golden State. The funding would provide immediate aid to communities facing dire water shortages and drought-related unemployment. Just last year, Governor Brown approved $687 million to accelerate infrastructure projects designed to conserve and distribute the precious resource.
The Agriculture and Labor Departments announced Friday that 10 states will receive $200 million to help participants in the Supplemental Nutrition Assistance Program, or SNAP, find jobs and work toward self-sufficiency. The grants were included in the 2014 Farm Bill, which also contains sweeping reforms of traditional ag programs. Gone are the days of direct payments, which compensated growers regardless of prices or yields, and producers now must decipher a dizzying array of new federal support programs. Paul Yeager explains.
Looming deadlines are putting pressure on farmers trying to weigh new commodity support programs included in the latest Farm Bill. And experts say the new guidelines, including significant departures from direct payments of recent years, can be challenging to understand.
We're hearing that some farmers are signing up, some are still confused about the process. There's a lot of meetings going on.
At one meeting in Eldora, Iowa in January, experts spent 2 hours outlining the best way to compare the various commodity programs. Despite praising presenters for walking them through the complex maze of information, some farmers are still less than confident with their decisions.
The bottom line is this farm bill has a lot of new acronyms, it's got a lot of new definitions, and so when we first started after the harvest season, guys just coming in off the combine, coming in out of the field, they hadn't any time to prep. So it was all new stuff, and basically they walked away stunned.
Crop producers, however, are learning new acronyms which, for them, represent the most important portions of the 950-page Farm Bill: PLC, ARC County, and ARC Individual.
I've got my own thoughts on what they may stand for, but I better not share them on TV.
Sure, agricultural risk coverage or something is the first one, and at the county level and an individual level and PLCI. Price loss coverage, is that pretty close?
When producers select price loss coverage, agricultural risk coverage county, or agricultural risk coverage individual, they are making a 5-year commitment. Between the reality that they are committed to their choice until 2018 and the fact that they are no longer guaranteed an automatic payment, the stakes are high.
That's what's scary about it, because it's so hard to predict where we're going to be 2, 3, or 4, 5, and especially 5 years from now. It almost seems algebraic in that we don't know what the price is going to be for the next 5 years. So we're going to almost have to kind of make our own predictions and let the chips fall where they may.
Some farmers wonder why the authors of the new commodity programs would make them so complex.
I'd like to know who they are. Be interesting to just see what their thoughts are as they set this up, to see if they know anything about agriculture or farming themselves, or if they're just know a lot about economics. It'd be hard to make it more complex.
At Market to Market's request, Leibold gave the non-simplified, acronym-filled explanation of all the factors a farmer should consider before locking in one of the programs.
If I was looking at ARC County, ARC CO, then I'd be taking a look at what's my adjusted gross revenue. So I have to take my Olympic yield times my Olympic price to come up with my gross revenue. Then I have to have my 14% deductible for my shallow loss. So I did multiply my my gross revenue by 86% to come down to my guaranteed revenue. And then I have to think of
His typical spiel is a bit more user-friendly. Step 1, update historical yield figures. Step 2, consider changes to your base acreage. Step 3, research ARC and PLC options. And Step 4, sign on the dotted line.
So it's fairly simple.
March 31st is the deadline for making changes to a farm's historic yield numbers. The opportunity to adjust those figures typically arises only when a new farm bill is passed.
The last time we did it was 2002. So if I encourage anything, I encourage our producers to get that data from your insurance agent or pull up your own records, bring them in and try to increase your yields, because that's going to make a difference on what your payment is.
Those who fail to make adjustments by March 31st will see their historical yield averages remain at levels established in the past. The other important deadline remains March 31st, when those with covered commodities should select one of the 3 programs. Otherwise, PLC is the automatic default. All the options require farmers to estimate future price trends.
Everything is so complicated and so complex. Like he mentioned, the economy of China and the weather in Brazil and what's going on with Russia. All those things impact the markets, and you cannot predict that future. You just really, he said, who would ever predicted $2 gas? Are you going to predict $2 corn again?
Richard Dreifke, a producer from Hubbard, Iowa, and his nephew Clint Miller signed up at the Farm Service Agency office in Iowa Falls last month.
We've decided to go into the ARC County program. It's based off the average market prices for the year, and it goes back 5 years. And with prices a lot lower now, they have been higher. There's going to be a payment for sure for 2014 and probably 2015, maybe some in 2016. With PLC, the price has to be under $3.70 for corn and $8.40 for soybeans. So I guess we're banking on prices being higher than that.
Dreyfke's nephew agrees.
There's more guaranteed money up front, and it's hard to pass that up. The PLC has a good floor for the future, but you never know if prices will get that low.
The whole idea behind this farm bill is to say, okay, we want to give the producers an opportunity to adjust to world markets and changing times. We want to protect them on the downside, but we're not going to bail them out completely.
Leibold suggests that producers, regardless of region or commodity, enter their own data into online calculators, such as those provided by Texas A&M or the University of Illinois, before selecting a program. Experts say farmers also should consider crop insurance carefully in light of the new programs.
With this farm program not having a guaranteed payment, I think it is shifting to promoting insurance and letting the producers know that there's no payment that's guaranteed. So you are going to want to insure your crop outside of FSA to make sure that you're covered in all areas.
Most producers acknowledge that despite the headaches, tax-funded support during tough times is something they cannot afford to lose.
It provides a safety net no matter which you choose for the farmer, and it's a necessity, I think, in today's times with as many dollars as we've got invested in a year's crop.
Many producers also are sensitive to the public perception that farmers are oversubsidized, and they understand why a different approach to government support is being tested.
I'm a taxpayer too, so why did I get why do I get a farm bill subsidy or payment when we had $7 corn? That's ridiculous.
Officials are asking farmers to stop at their nearest FSA office soon. Lines may run long as the deadlines near. For Market to Market, I'm Paul Yeager.
Next, the Market to Market Report.
And our traditional analysis segment is coming up in a moment. But before we get to the markets, we want to draw your attention to new educational resources that Market to Market is offering to agricultural instructors, students, and viewers of the program.
Market to Market Classroom connects teachers and students to stories about the science, technology, and business of agriculture from America's longest-running agribusiness television program.
Hello, I'm Mike Pearson.
The Market to Market Classroom website features learning modules that build upon core subject content, emphasizing critical thinking, research, and communication skills. You'll also find curriculum resources, challenge questions, and timely videos to help students gain a deeper understanding of the issues and challenges confronting agriculture in the 21st century. So we encourage teachers, students, and anyone else who wants to learn more about the business of farming, the impact of science and technology, and even the basics of commodity trading to visit iptv.org/market-to-market and click on Classroom to access this free online resource.
Creighton University's Rural Main Street Index fell this month to its lowest level in 5 years. The economists also noted that agricultural land values declined in March for the 16th consecutive month. This week, however, grain prices rose. For the week, May wheat gained 28 cents, while the nearby corn contract advanced by a nickel. Soybeans moved sideways as the May contract traded fractionally lower. Nearby meal prices followed suit with a modest loss of $3 per ton. In the softs, cotton recovered most of its losses from last week as the May contract gained $2.32 per hundredweight. Over in the dairy parlor, April Class 3 milk futures rose 13 cents. Livestock prices were mixed as the April cattle contract gained $4.08. Nearby feeders advanced by nearly $5, and the April lean hog contract lost $3.65. In the currency market, the U.S. dollar pulled back from 12-year highs posted last week. Crude oil lost another 50 cents per barrel on the May contract. COMEX gold advanced by $32 per ounce, and the Goldman Sachs Commodity Index gained less than 4 points to settle at 398 even. Here now to lend us his insight on these and other trends is one of our regular market analysts, Ted Seifert. Ted, welcome back.
Hey, thanks for having me.
And we are glad to have you. It was an exciting week for wheat growers.
Certainly
here.
was.
How much of that 28-cent move on the week was Friday?
A good chunk of it, and a lot of it was dollar related as well. Wheat is, of the grains, the most dollar sensitive because it's a global market. There's lots of global competition when it comes to wheat. So when it comes to end users, global end users looking for pricing, currency factors into that very strongly. So with a sharply lower dollar here today and the volatility that we've seen in the dollar this week is very beneficial to wheat. In the meantime, it just happens that we've got some weather issues there as well. So that's certainly helped fuel the fire also. So yeah, very impressive week.
Now, that being said, given that so much of this week's move was attributable to the dollar, should producers be making some sales here in the first half of next week, or do we expect the dollar to sort of chop around here for a while, maybe giving some additional opportunity?
I think ultimately you see the dollar go higher. And I think we are still going to see new highs in the dollar. I don't think we're going to be raising rates immediately, which is why we've pulled off highs, but it does look like we're going to start raising rates or getting more aggressive with that in the relatively near future. So I do think the dollar still will see new highs. Now, that doesn't necessarily mean that we need to be aggressive selling wheat as far as producers are concerned. I think we've kind of set the stage here now for a little bit of a weather rally. We needed a little bit of a spark, which comes in the form of the dollar, and we'll take it. But we could see a little bit of an extension of wheat, see a little bit more strength there. I'd be a little bit on pins and needles, though, because if weather starts getting better and we start flatlining, or especially if you start seeing more pressure come into the row crops again, then I think you do get ready to start making some sales. But at least for the moment, I'd like to see if we can carry that momentum into next week.
All right. Well, let's jump down and look at the corn market. Saw just about a nickel move this week in corn. Was that mainly spillover support from the wheat market, or is corn operating independently here?
Well, at first it was very much spillover from the wheat, and also, you know, from the dollar as well, because corn, although, you know, we are the major shop in the world for corn, our dollar still is affects demand as well. But corn, I think towards the end of the week, we started talking more about weather. The weather stories that have been so bearish coming into this week and through most of the week about the dryness that we're having, the reason we were looking at that bearish, the market was looking at it bearish, was for the potential for early planting and things like that. But if you get some sort of spark like you see from the dollar and from the wheat, then it's amazing how these stories go from bearish to a little bit bullish, saying, you know, well, we had a similar situation in 2012, we got it in early planting, and then we all know what happened with that. So, you know, I think weather concern is starting to build a little bit for corn. We're starting to realize that maybe we need to see a little bit more of a weather premium in corn. If we get the acreage numbers that the trade's talking about right now, we're going to have a really good growing season in order to sustain demand and not see a massive drawdown in ending stocks year over year. By the way, last year we set a record in corn yield at 171. The last 2 years that we've set corn yield records, 2004 and 2009, on average, we're 12 bushels an acre national average off that record year, the following year. So if we put that in the equation and corn drops from 171 to 159 on lower acreage, in my balance sheet, that's got us right around a 1.4 billion bushel carryover. That's a pretty sizable drawdown from year to year. If we had a bigger problem, which the West possibly could, and we get down into the lower 150s, 152 to 156, you start challenging that 1 billion bushel mark under the current demand structure, which would mean we need to price ration a bit. Ultimately, we'd cut out some demand and still have a fairly comfortable balance sheet, but it could lead to higher prices in corn.
So on this new crop, are you a holder? Just wait and see if we can get one of those sparks to really take us a little bit higher?
I'm decidedly much less aggressive on corn marketing this time of year than I have been in the last 3 or 4 years.
Any price targets out there that you think producers should keep their eye on, maybe for some incremental sales?
I think with, now, a big piece of this puzzle is going to be the acreage number that we see a week from Tuesday. But as long as that's not a big surprise, higher than what we're expecting, I do think that we'll get enough of a weather issue, even if it's not hugely impacting yields. We'll get enough of a scare. We'll see something in a 2-week forecast we don't like, to give us, I think, at least 450 to 475 corn. If we have something that persists, I could easily see 5.25 to maybe 565 if we do have a real issue.
All right. Now, you've talked a little bit about the acreage report coming out March 31st. We've got a question here from one of our followers on Facebook. Tim in Crookston, Minnesota is curious, what commodity do you think could be the bracket buster in this year's March Madness Planting Intentions report?
Nice question, Tim. As far as bracket buster, meaning what do we have to the
What's going to be the big surprise?
Okay. Personally, I think it's the soybean acreage number. I see a lot of these numbers between 87 and 88 million acres of soybeans. For me, that's just really high. It feels a lot like when we were talking about yields this summer, about 180, 179, 178 for corn. We tend to overshoot the mark when we get excited about something. And I think we're getting a little too excited about the soybean acres. I think you do see an increase in acres. I do think you see a record. Again, the numbers I think are going to be bigger than USDA's baselines. But I'm thinking somewhere more along the lines of 95. In fact, my current number is 94.8. So I'm one of the lowest ones out there when it comes to soybean acres. So obviously that is going to be my pick for a surprise on this report. I do think corn numbers could come in slightly higher than expected, but I'm not seeing a big increase in acres overall. With low prices, I think you're going to see a lot of milo, a lot of sorghum, a lot of barley, a lot of sunflowers planted. And overall, I think I've got overall acreage between the big three dropping about just shy of a million acres.
All right. Well, now, real quick, let's talk soybeans, then particularly new crop beans, given that you think the acreage jump might be as high as some of the other analysts are anticipating. What's your take on how do producers market those new crop beans? Do you make some sales today?
Yeah, see, that's the funny thing. Even if you get a surprise on this marketing or on this acreage report, and it comes in lower than expected, we might get a knee-jerk reaction higher off of that. But it won't take long for guys like me to sit there and pencil in the new numbers and realize that it's still going to be very easy to see a 500 million bushel carryover in beans for next year. So I don't think that if we do see an 84.5 to an 85.5 million acre number for soybeans, I don't think that's a sustainable rally there. So I'm a lot more aggressive in marketing soybeans this year than I am corn. And I'm between 40 and 60% in most places.
All right. Well, now let's jump down into the livestock markets. We saw a big jump in both cattle contracts, live cattle and feeder cattle, and there hasn't been much cash live cattle traded here in the past 3 weeks. Do you anticipate that the live cattle futures to move up here in the short term?
Well, I think what we've done is to find our range. I think we overshot the mark to the upside when we got all of the speculative traders excited about getting into this big bull market that we were having at the time. And then when we broke that, you saw these speculators run to the door, and you saw the market really try to flush out a lot of these speculators. And in lower volume markets, like feeder cattle in particular, that flush out can be pretty nasty, as it was in cattle. So now at this point, again, I think we overshot the mark to the upside. I think we might have overshot the mark to the downside. Now we're recovering into a price level, which I think is more fair value. So I think we can trade this range for a little while. In the near term, I think you can see a little bit more upside potential, but longer term, I think those highs might stand unless we get the speculators really interested again. The cattle on feed numbers being at the lower level since '96, that's sort of old news. You know, I don't know if the Wall Street Journal type guys are going to come in, doctors and lawyers aggressively buying cattle again. I think they might have learned their lesson when we saw that big break. But realistically, the fundamentals are such that we should be trading at some pretty darn good prices, and we are, and we could see a little bit stronger prices over the coming weeks.
And do you see the same story taking place in the feeder cattle market, still defining that market?
Yeah, still defining that range. Again, now that we're back into the area that we are, I think we could still see a little bit higher prices in the near term. You know, cattle on feed numbers were really quite bullish, so I think early next week we'll see a little follow-through strength there. The breaking the dollar is also pretty beneficial for livestock, cattle as a whole. So, yeah, I think we can still see some higher prices there as well.
All right. Now, another interesting story that happened this week was the lean hog numbers. We saw that market hit some multi-year lows 2 or 3 weeks ago, bounced off of them, and this last week we just sold right through them, even as the dollar declined. Talk to us a little bit about what's going on in that market.
So, you know, with that bounce and sort of consolidation that we had there, from a technical point of view, we were looking at that as the first consolidation that we saw in that big drop, first real consolidation we saw in that big drop. Generally speaking, that doesn't usually hold for a bottom. It's a lot of times a midway point. In this case, I don't think it's necessarily the midway point, but we weren't really buying the idea that the lows were in. As far as news is concerned, overall, fundamentally, I mean, the bottom line is we really overshot the market with PEDV. We not only overshot on prices, but we also overshot on production, figuring that we were going to have this PED virus really thinning out our hog herd. And that never really seemed to be the case, or never really came to fruition. But not only that, you throw the bird flu issues on top of that. A lot of countries are now banning our exports of poultry, turkeys in particular. And the idea there is that with more domestic supply of poultry, you might see a hit on demand in hogs as well. So for the near term, that's been a bearish story. Now that could turn around at some point, because if we really have major issues with bird flu like China did a few years back, and we start having to cull flocks and flocks and flocks, and we lose a big chunk of supply on the poultry side of things, then pork might have to step in to fill that demand. But until that happens, it's still a negative influence on the pork market.
So we'll probably watch it continue to slide, maybe another few dollars lower?
Yeah, I hope not, but there's really not too much to get excited, either fundamentally or technically at the moment. You got to kind of expect it, kind of take it with a grain of salt. Hope it doesn't happen, but know that it could.
All right. Well, thank you so much, Ted, for joining us this week.
Thanks, Mike.
That wraps up this edition of Market to Market. But Ted and I will continue our discussion and answer some of your questions in our Market Plus segment online. You'll also find audio podcasts and streaming video of our program exclusively at the Market to Market website. Now be sure to join us next week when we'll examine the seismic impact of fracking that is putting Oklahoma's oil industry on shaky ground. So until next time, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company. Offering a full line of grain drying and storage equipment and steel buildings, Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.